The biggest lie in personal finance is that investing is complicated. And people think that beating the market it requires secret knowledge or nonstop research, expensive software, or some genius level understanding of economics. And that belief is exactly why millions of people constantly underperform while its strategy is so simple. It almost sounds lazy, quietly crushes them every year, year after year. And the crazy part is, this strategy does not rely on predicting crashes, timing rallies, or picking the next giant company before everyone else notices. It works because it removes the one thing that destroys most investors: human emotion. And most investors lose money for one simple reason: they cannot stay consistent. They panic when prices fall. They get greedy when prices rise. And they constantly jump from one trend to another, trying to chase whatever made somebody rich last month. And one year it is a tech stock, and the next year it is crypto, then AI, then real estate, then options trading, then some influencer screaming about passive income while standing next to a rented Lamborghini. Meanwhile, the strategy quietly outperforming them is sitting there doing almost nothing except buying consistently and refusing to react emotionally. And that strategy is dollar cost averaging into low cost index funds. It sounds boring because it is boring, but boring is usually what makes money. And the stock market is designed to reward patience more than intelligence. A low cost index fund simply tracks a large group of companies instead of betting on individual winners, instead of trying to guess which company will dominate the next decade. You own pieces of all of them. And one company fails, another rises. And over time, the economy grows, businesses expand, and innovation continues. And your investment rides the entire wave instead of gambling on one surfer. And most professional fund managers, they fail to beat the market long term. Study after study has shown that actively managed funds regularly underperform simple index funds after fees are included. And think about how insane that is. People will team up teams of analysts at advanced software, finance degrees, Bloomberg terminals, and access to endless data. They still struggle to consistently outperform a strategy a teenager could automate from a phone in 10 minutes. And the reason is simple: markets already price in most available information. And human beings are terrible at predicting short-term movement and consistently. And the average investor makes it even worse by trying to time everything. And they wait for the perfect moment to buy. They think a crash is coming, and then the market rises without them. And when they finally buy in, prices dip and they panic sell, and then they wait again. And while the market recovers, this cycle repeats endlessly. Emotion becomes more powerful than logic, and dollar cost averaging destroys that problem because it removes the decision making. You invest in a fixed amount on a fixed schedule, no matter what the headline says. Markets up, you buy. Markets crushing, you buy. Recession fears everywhere, you buy. Everyone acting euphoric, you still buy. And over time, this smooths out your average purchase price and eliminates the impossible task of perfect timing. And the reason this outperforms most investors is not because it finds magical returns. It outperforms because most investors they sabotage themselves. Imagine two people starting with the same amount of money. One spends years chasing trends and panic selling and trying to predict the future, and the other simply invests every month into a broad index fund and ignore the noise. 10 of 20 years later, the second person usually wins because consistency compounds while emotional decisions making destroys momentum. Compounding is the real superpower. Almost nobody respects any enough. It is not just, earning returns on your money. It is earning returns on your previous returns again and again for decades. And small contributions start behaving like giant snowballs rolling downhill. The earlier you start, the more ridiculous the results become. And someone investing consistently from age 25 can end up with significantly more money than someone investing larger amounts starting at 40, because time matters more than intensity. Yet most people, they delay investing because they think they need more money first. They wait for a better salary, a better economy, a better president, a better housing market, or some perfect moment that never arrives. Meanwhile, time keeps moving. And another reason this strategy works so well is because it embraces simplicity. Complexity feels intelligent, but complexity often hides bad decisions. People love complicated investment strategies because complexity creates the illusion of control. They think it's something sounds advanced, it must be superior. In reality, many wealthy investors built fortunes through painfully simple habits repeated consistently for decades. Warren Buffett himself has repeatedly praised how low cost index funds for ordinary investors because he understands something most people refuse to accept. Average returns sustained consistently are far more powerful than unpredictable attempts at extraordinary returns. Social media has completely distorted investing too, expectations wise. Everyone sees screenshots of massive gains overnight, crypto millionaires or options traders turning tiny accounts into huge balances. And what nobody shows is the thousands of people losing money behind the scenes. Slowly steady investing is not exciting enough to go viral, but excitement is usually the enemy of wealth building. Casinos are exciting too. That does not mean they are designed to make you rich. Real investing often feels boring because successful investing is mostly about discipline, patience, and ignoring distractions. Another overlooked advantage of index investing is diversification. When you bet heavily on a single company, your future depends on one business surviving and thriving. Even giant corporations can collapse. History is filled with companies that once looked unstoppable before disappearing completely. Diversification protects you from being catastrophically wrong. Instead of needing one company to dominate forever, you benefit from the overall growth of the economy itself. Markets crash also becomes easier to handle when you understand this strategy, and most people see crashes as disaster, and long term investors see crashes as temporary discounts. If you're consistently investing for decades, lower prices actually allow you to accumulate more shares. And the media will always amplify fear because fear generates attention. And during every major downturn, people claim the system is collapsing forever. Then eventually the markets recover and reaches new highs. It has happened repeatedly throughout history, despite wars, recessions, political chaos, inflation, pandemics, and financial crisis. Watch your portfolio fall hurts emotionally, but long term success depends on understanding that volatility is normal. The market rewards people who survive emotionally long enough for compounding to work. Another major mistake investors make is obsessing over short term performance. They check their accounts constantly and treat investing like a video game scoreboard. Daily marketing movement means almost nothing for long term wealth creation. Yet people let a single bad week completely alter their strategy. Imagine planting a tree, then digging it up every few days to check whether the roots are growing. Constant interference kills progress. Investing works similarly. Sometimes the best action is doing nothing and letting time handle heavy lifting. These are another silent killer most investors underestimate. High expense ratios, management fees, trading costs, and constant buying and selling quietly drains returns over decades. A low cost index fund keeps expenses minimal, which means more of your money continues compounding for you instead of enriching someone else. Even a 1% difference in fees can translate into massive differences over a lifetime. And the hardest part of this strategy is psychological. People constantly feel like they should be doing more. They want action, they want certainty, they want excitement. But successful investing often requires resisting those urges. Wealth building is usually repetitive and uneventful until suddenly years of consistency create results that seem impossible to outsiders. People will call you lucky without seeing the discipline behind it. The truth is, most investors are not defeated by the lack of information, they're defeated by the lack of patience. And information has never been more reliable than it has been today, and everyone has access to financial education, market data, investing tools directly from their phone. Fear and greed remain undefeated for most people. This is why a simple discipline strategy continues outperforming complicated emotional investing. It is not flashy enough to sell courses or generate headlines, but it quietly works. And in the end, the investors who usually wins are not the smartest, the fastest, or the most aggressive. They're the ones who stay consistent the longest. They understand that investing is less about predicting the future and more about building the habits that survive uncertainty. While everyone else chases shortcuts, they keep buying, keep holding, and keep letting compounding do the work. The simple approach outperforms most investors not because it is magical, but because most people refuse to stay disciplined long enough to experience its power. Thanks for watching today's video. If you could for me, just subscribe. If you found value in today's video, just subscribe. That's all I ask. I really appreciate that. And without that, I can't grow on YouTube, so I desperately need the subscription base. So if you would, please subscribe. Thanks for watching, and we'll talk to you guys tomorrow. Have a good day.